Okay, so welcome once again. And now I'd like to be able to screen share from my side from RDA, just give you a very quick snapshot of who we are and what we're doing at RDA. So in terms of this, I'm just going to slide down. Okay, so for those of you who don't know RDA, Regional Development Australia is an Australian government initiative right across Australia, and there are 52, of which 12 are in Queensland. And we're in the big red circle there and cover a region roughly the size of a quarter of Queensland. So a very large region, but with a population of roughly 270,000 people. Our committee operates as a not-for-profit incorporated association, but with funding from the Australian government. Our minister appoints our chair, and then committee members are appointed through a chair recruitment process to committee members. So we operate across that region, and in particular for us, very important stakeholders are our 15 local governments within that area, and we work very closely with them and other state government, federal government and private sector people in the space of economic development. Simply put, our role is to facilitate and advocate for regional economic development. And from earlier this year, we had a new RDA charter, and you can see the 4 dot points there. It really is very much about regional economic development, how we're creating more jobs and sustaining those. As an example, some of the projects our RDA has been working on include an economic recovery and growth strategy following on from COVID, its impacts, and of course before that, flood impacts and drought impacts. That document has been advocated through to key stakeholders in the Australian government, Queensland government, and we're continually briefing ministers, members of parliament, senators and private sector businesses on the opportunities we see ahead for our region. Also, we have a range of other projects that are about attracting investment and driving jobs in the region through road infrastructure projects, construction skills and jobs in the construction and particular civil sector. We're also advocating for STEM skills in the region and what we need to do to lift that bar to make sure all of our youth have the skills that they need for future jobs in our region and beyond. And also, last but not least, we've been doing initial seed work on developing aviation industry opportunities in our region. Many of you will have heard through the news that there's a new Boeing and Queensland government facility out in Cloncurry to test pilot drone equipment, and that's a very exciting development for our region. So with that very short introduction, I'm going to now hand over and introduce to Gerard and Louis to take us through the update from NAIF. Many of you will have heard from NAIF over the last few years. You'll know that they've had a $5 billion fund to support economic development in Northern Australia. But what is really timely about our presentation today is to be able to share with you the insights on not only how NAIF is operating now and some reference to case studies, but also what's coming up and proposed to be put through the House of Representatives and Senate to be able to make it even more flexible and more user-friendly going forward. And with that, we hope that it will support going forward. We'll see even more projects in our region being funded and creating the jobs and prosperity for the North. So with that introduction, I'd like to hand over now. I'll stop sharing my presentation and invite Gerard and Louis to load up their presentation through screen share.
Thanks very much, Glenys, and thank you everyone who's participating online. Thanks to the RDA, not only for putting on today's session, but Glenys, I know you've been quite influential in these reforms as far as talking to people about how we could streamline the NAIF to make it even more effective, as you said, in delivering for Northern Australia, and we very much appreciate that. So thank you very much for that. Ladies and gentlemen, as Glenys has outlined, I'm going to talk a little bit about NAIF 101 in the first part of my presentation, and that will set us up to go through what are really quite a substantial number of changes to the NAIF and how NAIF operates. Importantly, I'll give you a bit of information about how we've gone over the last 12 months. So there has been a strong 12 months up until now, but with these reforms, we expect to be able to go further, as in a broader scope of projects, and that's not just in different sectors and in different styles of product, but also in different styles and sizes of loans. So it's quite exciting for us. I'm hoping for other people in Northern Australia, they also find it just as exciting as we do. And I look forward to sharing, and also very much look forward to the questions that you guys will have. So I'm just going to go and share my screen now. As I do that, I'll just mention, as Glenys said, I am the in charge of, I've just made a little error there, Glenys, just one sec. What are we doing here? This is the This is the nature of these things. So I'm going to hit screen share and bring up the screen and share it. I mentioned I'm joined by Louis. As Glenys said, Louis is running our agriculture and water portfolio at the moment. So he's our sector director in that space. One reform about NAIF that you don't read about is that over the last 12 months, we've gone through a quite large organisational reform. One of those organisational reforms was I was created, as in we didn't have an executive director of stakeholder relations and communications. And importantly, we also looked to divide our portfolio across a number of sectors. So the people who led those sectors became experts in those areas. And Louis has been leading our agriculture and water portfolio since then. I'll go to from the beginning for the presentation. Hopefully that shows for you. As Glenys just did before, I'd just like to make an acknowledgement of country and say that NAIF acknowledges the traditional owners of the country throughout Australia and their continuing connection to land, sea and community, and we pay our respects to elders past and present. Obviously, being all the way across Northern Australia, our connection to Indigenous communities is extremely important. And one point that we'll talk to as we go through this presentation is that all NAIF projects have some form of Indigenous engagement strategy around them. And that's, like all things, aimed at getting outcomes for all members of the Northern Australian community, and the Indigenous folk being quite important amongst that. The first line I've got here, I suppose, starting very basically, is looking at what the goal of NAIF is. So NAIF's mission is to generate transformational growth in Northern Australia through being an innovative financial partner. Now, in that, the key word is innovative. Up until now, we've been able to offer what they call project debt. And I suppose over time, we've learned how to provide that project debt, which is debt that's tied to a specific project, in a number of different ways, which has been quite innovative. Importantly, these changes will lead to more innovation and hence enable us to be an even more effective partner for people trying to develop projects in Northern Australia. Our key focus is to drive public benefit, which we define as jobs and economic growth, and also Indigenous involvement across Northern Australia. Just skip a slide there, just one sec. This is the NAIF area, for those who aren't aware. So the NAIF area is basically divided by the Tropic of Capricorn, although there are some interesting exemptions. Gladstone is an interesting exemption, so we lip down to pick up Gladstone, and also any local government area where some part of that goes over the Tropic of Capricorn. So that's why you see a number of local government areas in Queensland, which extend quite far to the south, including like Blackall local government area, and a number of large local government areas in Western Australia where these areas are just massive, the councils there. So little bits of those will come over the Tropic of Capricorn and we will pick them up. The other thing that governs our area is it's all of the Northern Territory. So there's no distinction the Northern Territory being above or below the Tropic of Capricorn. NAIF was started in 2016 and it was started with $5 billion in capital, which was to be lent out to projects in Northern Australia. It can be either senior or subordinated debt. And as I mentioned before, the key focus is on economic benefit, which is jobs and economic growth, and also Indigenous engagement and outcomes. I mentioned before that we'd broken out across a number of sectors, and those sectors are energy, transport, social infrastructure, agriculture and water, and resources. We can do deals in other spaces, but at the moment, they've been our primary focus to try and drive growth in the fund. And how do we do that? Well, we've got a number of what we call financing tools. Now, the basics of how these financing tools are come together is that the NAIF borrows in the same ways which the Commonwealth Government borrows. So we borrow for 30 years and we borrow at the bank bill rate. Now, that enables us to do a number of things. The first is we can provide longer tenor than a commercial bank. We don't in fact, we've never offered the full 30 years, but there's a number of situations where we offered 15 to 20 years, which is longer than what a lot of businesses would get from a commercial bank. We can tailor our amortization and repayment profiles. Now, one of the reasons we can do that, because we've got more time, more tenor, means that we can provide a bit of a holiday up front to repayment because we'll capture it over the next 15 to 20 years. We can do fixed rate because the Commonwealth Government borrows at a fixed rate. So we can provide that over a long term, as I described before, which can be really, really useful when trying to underwrite a project. There are certain concessions we can provide to interest rates, though I do note that interest rates are low at the moment and everyone gets a pretty cheap rate. But still, we can provide a very competitive rate even in these markets. And the final is we have a different view of risk to commercial lenders. So we're happy to be subordinated. So hence, we're happy to take a lower level of claim on the proponent's assets than other private sector lenders would. What we'd like to do in those situations is use that capacity to crowd in other investors and other private sector lenders, so that our involvement leads to other people being involved in these debts and also the development of Northern Australia. How's our performance to date? Well, at the moment, we've made offers of $2.7 billion, which is in the media. There's a couple of others in front of the Minister's desk at the moment, which take us over $3 billion. So what happens in that situation is our board does what they call an investment decision. So an investment decision is basically where an offer of funding is made to a proponent. So at the moment, that number is at 2.6 in the public, but there's some more to come, which will get us over 3 billion in the next month or so. Now, the next stage in that process is that once a number of conditions precedents are met, we get to what they call contractual close. Now, at contractual close, both the NAIF and the proponent are contractually obliged to deliver on a debt agreement. Now, what that means is we provide enough certainty at that point for the other side to start investing their equity, which more than often goes in first. Now, that for us is the point of economic enablement, where money gets spent, where people get employed, and where works get commenced. So we're at the moment at 1.2. Again, over the next month or so, we hope to see that up to about 1.4, 1.5 billion dollars in contractual close. So that amounts to 23 decisions in total. But over the last year, we've done 9 investment decisions, and that's got us also to contractual close on 10 transactions. So we've had quite a strong year. I think in total, those investment decisions were over about $1.2 billion just in their own in the last 12 months. So that underscores what's been quite an acceleration in the performance of NAIF over the last little bit. And that's become about for a few reasons. One was there was a change to the Act and mandate in 2018, which increased the scope for NAIF to lend money. And the second is, I suppose, over time, you just learn how to apply a product. And our team has certainly learned how to be innovative in applying that product, and that's helped a number of innovative proponents get their projects forward. As far as where that money sits, well, at the moment, about $1 billion of the amount that's been offered in WA, $1 billion in Queensland, and just under 700 million is in the Northern Territory. And this one here, guys, I'll just leave as a bit of a listing of the projects which we have currently funded. The key ones in the agriculture space are we've done a lot of agriculture. We've done aquaculture in the Northern Territory with Humpty Doo, Barramundi, and we've funded Signature On Farm, which is an abattoir near Claremont, and just recently AgriPower, which is a fertiliser producer near Charters Towers. So that concludes a summary of NAIF and where we are. What I want to talk about now is NAIF and its future. Now, Glenn has mentioned that we are at a stage where a number of reforms have been devised and put before the Parliament. The time frame on these reforms are that they were introduced to the Parliament about 2 weeks ago to the House of Representatives. They were then had the second reading, and they'll be voted on Wednesday. After Wednesday, they'll go to the Senate and they will be approved before 30 June, because one of the most important reforms is they will extend the NAIF mandate from 30 June of this year to 30 June 2026. So all of this stuff is very current, and we are working pretty feverishly at our end to look at ways in which we can operationalise these reforms. So basically take what the Parliament is going to do and make them into programs that can help proponents. All these reforms, they fit into 2 clear groups. The first is quite an interesting change to legislation, and that is the removal of the link to construction. So if you think about it this way, currently in the NAIF Act, there is a line that says NAIF funds the construction of infrastructure. And what we effectively do is remove the word construction. So NAIF funds infrastructure. Now, what that means is we can fund a whole range of things other than project lending, which I mentioned is what we can do at the moment. as long as it leads to what we define as infrastructure in Northern Australia. Now, examples of that scope, which I'll go into now, is that we will be able to fund commercial loans for proponents. So instead of funding at the project level, we fund at the balance sheet level. That leads to a whole different concept around collateral, but also enables us to do a deal where we say we'll be prepared to do a corporate loan as long as in the end you deliver us a series of projects in Northern Australia. Different way of getting the same outcome. It also allows us to aggregate. Aggregation is where we can take some of our funding and provide it through third parties like banks and organisations like QRider here in Queensland, who we are in discussions with. And they can do smaller loans because NAIF's not built to do small loans. NAIF's an organisation of about 30 people. And to be honest, at the moment, under about 15 million, even with a heap of concession, we are not efficient. So bringing these third parties in allow us to become efficient. The next thing which we'll do in some time, certainly not an urgent thing, is allows us to look at different funds that we might like to seed that could also invest in Northern Australia. And what we'll be doing there is try to crowd in or capture other private sector investors. So the first range of changes I want to talk about is those changes which are caused by the removal with the link to construction. So the first one is around corporate lending. And I think for an agricultural meeting or group, it's important to try and think about how we would use this in the agricultural space. So there's a number of examples. The first would be if it was a large corporate, which say owned a number of operations across Australia and had the opportunity to prioritise certain projects that were in Northern Australia. So they might have food packing within Northern Australia and Southern Australia. They might be growing a certain product in both jurisdictions or only in Northern Australia. But at a project level, it may not make sense for us to provide funding to that. They may have very good relations with their current financier. But at a corporate lending or at a corporate level, the idea that NAIF might provide some debt at a longer term, at say a fixed rate, would lead them to bring forward those projects in Northern Australia so that we could get the benefit of them now and that we could get the benefit of them in a manner which best delivers for the community. So using the sort of the NAIF benchmarks of public benefit and Indigenous engagement. So if we could agree a group of projects with a corporate like that, then that's a stage in which we could do that. It could also be used for other large corporates that may own 1 or 2 properties within Northern Australia. It's all about the outcome which we could derive from that. And Louis will talk about that a bit later when we talk about questions. But we think this is a really powerful tool that we can do to bring forward projects in Northern Australia. The next is the concept around smaller transactions and third-party lending. So I mentioned before, at the moment, NAIF really struggles to deal in transactions under $15 million and make it efficient for the proponent. What we're looking at doing is going with a number of third parties. I mentioned potentially commercial banks, but also organisations which are related to government like QRider, and coming to an agreement where they do a number of things. Firstly, they provide the back office for us to do a smaller loans program. And the Minister has given us a goal to get down to loan size of $1 million, and that's certainly a goal which we will meet. We will also look to do the public benefit test and the Indigenous benefit test at the higher level. So with the third party proponents, so there will still be delivery of outcomes in both of those spaces, but rather than having all of that cost borne by the proponent, a large part will be borne on a group level at the aggregator point. So that will enable us over time to roll out a reasonably large amount of funding, firstly in what I would call an all-comers type format, where we would set up a program where any project that fits the NAIF mandate and is of that smaller size can make application to that program. In time, as we get more comfortable with this program, we may look to do things which are more specific to certain sectors or certain policy outcomes. The trick is to get an understanding of how it works on the broad basis first. In the very short term, we will have some announcements to make in other jurisdictions where we have had continuing negotiations in this space, and they'll give people a little bit more understanding about how it will look. An important goal for us is, with the legislation planned to be passed by 30 June, is to have a form of these arrangements in place very close to when the legislation comes to power. So this is an area of key focus for us and for the federal government. The next area, which I said we will look at more in time than right now, is it does give us the opportunity, through moving the connection with construction, to look at investing in funds. That's a little bit nebulous maybe for some people on the call, but think of it very simply that if an organisation like a QIC or an industry fund or something on those lines was looking to put together a fund, or could be convinced by us to put together a fund that invested in Northern Australia along the same lines as what the NAIF mandate is, then we would be interested in seeding that fund or providing some initial capital to that fund if that other party was prepared to put extra money in to leverage our investment. Now, again, in the same way as looking at smaller transactions, in its initial phase, that will be, I think, an all-comers strategy. But over time, I see no reason why we wouldn't have funds, if this was to work, that looked at specifically at agriculture, or for that interest at transport or resources. Exciting area, but one which will take us some more time to work out. The next big thing, if you look at after taking away the connection to construction that comes from the reforms to the NAIF, is that 10%, or at least up to 10% of our allocation, our $5 billion allocation, can be converted to equity. So everyone knows in the call that equity is different to debt. Equity has a higher amount of risk, and often a project in our area we have found is not struggling for lack of debt, it's struggling for lack of equity. So we can make equity investments of no larger than $50 million, and we're not allowed to have a majority or a controlling position in the investment. So the Commonwealth doesn't want to run the business, but the Commonwealth is prepared to fill a gap if a gap exists to get a project up and running. Now, our view of this is we're going to try and use this power for those projects which really do make a difference to communities. Now, they can make a difference to communities by creating an industry, or creating infrastructure that enables other activities, or just making a community more livable, as long as it provides some form of return on our equity, I must say. Now, transformational projects are something which are talked about a lot around NAIF, and certainly they are a key focus of what we do. However, in a whole range of communities, smaller transactions are transformational. So we would look to use some of these opportunities of a lot less than $50 million, though not at the micro level, because we still have a little bit of an efficiency issue, to try and enable those projects across our mandate area. Internally, we have been looking to employ a head of equity and tool up our team so that we've got equity specialists and people who can do both debt and equity to administer what is a very different product for us. But I must say this is quite exciting. Other Commonwealth government entities do have the opportunity to invest equity, but not in this manner, not with a limit as high as $50 million, and not with a concept that, yes, we can't have majority or controlling, but an organisation like the Clean Energy Finance Corporation, from my understanding, is limited to about 20%. So we've got a lot more scope than what they have in the space. So exciting, interested in people's ideas about how that might be deployed over time. The next big change from the changes to NAIF are a modification to the definition of infrastructure and to public benefit. And whereas I say it's a modification, it's a pretty substantial change, at least in how you define infrastructure. So infrastructure is what we all understand it to be, which is physical infrastructure, but then anything that economically enables it. So what that means is, and I use an example, I suppose, of, I mentioned that we'd funded an abattoir in Claremont. Before the first Act and Mandate change in 2018, which also changed the definition of infrastructure, we would not have been able to fund that project. Under our current mandate, we could fund the fixed structure, so the building, and the fixed equipment, the stuff that doesn't move. Under this broader definition, we can also fund the non-fixed equipment. We can train the workforce to work on the fixed and non-fixed equipment. We can fund the software and computer hardware to optimize the performance of the equipment and the abattoir. We can fund the trucks that transport the cattle to the abattoir. We can fund the fridge wagon that takes the cattle, the meat, away from the abattoir. We could also, in theory, fund a lot of the accommodation and those other subsequent things that would bring a workforce to the abattoir. So we've greatly broadened the definition of what infrastructure is by using that concept of what economically enables the infrastructure. In many ways, it's easier to look at what's not included in the definition than what is. And what's clearly not included is the purchase of land when it's not critical to the project. And it doesn't relate to anything that looks like working capital or the operations of a business. But anything that's tied to infrastructure is definitely under the definition. The second major definitional modification is that we have changed the definition of public benefit just to focus on our goal. So we used to have the broader benefits of the broader public benefit definition, which looked at a whole range of things that impacted on the community and the Northern Australian community. Now it is quite simple. It is, does it create jobs and economic growth in our area? If it does, then it meets the criteria. The more jobs you create, the more economic growth you create, obviously the more concession you can receive. So public benefit is jobs, economic growth, local supplier opportunities and Indigenous opportunities, but primarily it's jobs and growth. And generating those basically, as far as public benefit is concerned, makes you eligible for a NAIF loan. The final one is more of an efficiency gain from us, and it's to do with direct lending. At the moment, due to a quirk in the Constitution, when NAIF lends money to a proponent, we actually lend money to the state, in this case Queensland, and then Queensland lends the money to the proponent. Now, the reason for that is it's a way to deal with the Constitution's want to not have the federal government provide a preference to any of the state jurisdictions. Now, unfortunately, that's exactly what NAIF does. NAIF provides a preference to Northern Queensland, the Northern Territory, and Northern WA. So when we initially looked at how to do this, the way we dealt with that constitutional quirk is we went to the states and we lent the money to the state of Queensland, the Territory of the Northern Territory, or the state of Western Australia, and they then on-lent it to the proponent. Now, we really value our state partners, and certainly over the last 12 months, we've had an exceptional relationship with Queensland, the Northern Territory and WA. However, all parties would say that this leads to a certain level of inefficiency. And also with the new efficiency we're trying to drive through those other changes, we needed to try and work out a way to align the administration with it. So what the federal government has decided to do, that in a large proportion of cases, but not all, we will be allowed to use other constitutional powers to lend money to projects in Northern Australia. Without wanting to go into huge amounts of detail, that leads to the use of the corporation's power, of the commerce between the states power, of the overseas treaties power, of the railways power, of the ports power. So there's a whole range of powers that we can act under, and that we will look to do that to act more efficiently as far as how we transact with proponents. So everybody, what we've got there, I think, is an overview of NAIF and how we currently work. We currently work as a project lender. We currently have a series of tools which we will continue to have and which we can continue to lend to projects. With the legislation which will be passed by the lower house on Wednesday and then go to the Senate to what we believe, given support of both sides of Parliament, to be passed by 30 June, we have a dramatic increase in scope in what we can do. We're very excited by that. We're working very hard to what we call operationalise it. And what we're doing today is to sort of open it up to the broader community, let you know about it, also ask for your feedback and your questions, which helps you hopefully, but I'll tell you also helps us in getting an understanding about what we're trying to do as far as bringing these reforms into place and continue to drive development in Northern Australia. So with that, Glenys, that's the end of maybe the talk, and apologies to everyone that I talk so much. It is a professional hazard, but I think we've finished with half an hour for questions, which will be perfect for us if we've got a good half an hour of solid questions.
Great. Oh, well, thank you so much, Jared. That's a really good briefing, and I'm glad you covered off at the end that it is going through the House, but obviously a lot of work has been done to make sure that it can transition through Parliament, hopefully clearly, safely, and no last minute hiccups. I had a few inquiries about whether this was premature or not, and our view here at RDA in Townsville, Northwest Queensland, was we want to get the information out as quickly as possible so people can be prepared and start to think about what those options are for their own businesses or communities, rather than waiting for it to drop into the system in legislation. So with that, thank you again for that. Also, just a reminder, everyone, if you've got any questions and you'd like to ask, if you could just pop them in the question panel for us. I can't see any there at the moment. You must have stumped everyone with all the information, Jared. You've done very well.
Maybe they've gone to sleep. That could be the problem too.
No, I can see some people online that I'm sure will come up with some questions, and I could pick on a few if I feel so so mean to a few, but I'm sure there are some out there. But I guess from our perspective, we're really excited about the smaller level of projects that can be coming through. And I was just wondering, given our agricultural focus, before a question arrives, and once again remind everyone to use Q&A for that at the bottom of your screen, all you have to do is hover your mouse, your cursor towards the bottom of the screen, and you'll see Q&A pop up. If you type in a question, I'll be able to forward it on to Jared and Louis for an answer. But one of the things that strikes me is with being able to look at agribusiness today, you've got already some agricultural projects that are getting funding in the NAIF system. I'm wondering if you could just share a little bit about the insights from the projects that are already supported through NAIF.
I might throw to Louis for that one, because Louis is the one who deals most in the space. Before I do, but as we go through this, just for the people in the Q&A, and we'll talk about aggregation and smaller transactions and those sorts of things and what Louis is working on, because he also runs the aggregation piece for us, is I'm really interested in what people think should be funded in that smaller space that will help agricultural businesses become more productive in Northern Australia. So that might be something for people to think about while Louis is answering that question. But Louis, insights into what we've been dealing with up until now.
Thanks. Thank you, everyone. And thanks, Jared, for that. Look, in terms of the existing agricultural loans that we've got in our portfolio, typically they're existing businesses that are looking to expand, expanding operations, whether they expand current operations or look to vertically integrate. And in the agricultural space, greenfield projects are more difficult to fund, simply because of some of that revenue certainty. And when you've got an existing business that has an existing revenue stream, it's, I guess, a much more bankable product. But I guess going to the point around loan aggregation, and one of the reasons why I think I'm sort of looking at that is, historically, most of the inquiries we've had at NAIF in relation to those smaller loans have come from the agricultural space. So, and we expect that the majority of the demand for the small loans will actually stem from that sector as well. So, so we'd be very interested to hear some of the feedback that from the people on this call have around, whether that's a correct assumption on our part, but we've certainly been looking at it from that lens.
It's about too whether there's a gap in the market, isn't there, where the commercial lender is.
Yeah.
And if someone was to come into that market with a longer tenor, and we've done some research on this space, we believe it to be the case, but always keen to test it, is that if someone comes into that market with a longer tenor, if that will allow agricultural producers to do different things with their operations than they would with some, say, shorter tenor commercial debt. So that may lead to other bits of infrastructure or wire and water or those sorts of things, which over time might lead to higher levels of productivity. So we're very keen to test that idea with your audience too, Glenys.
Okay, good. Well, we've got some questions flowing in, which is great. Just a simple one. We will make the presentations and the copy of the webinar available, so you can happily share that. But from Jonathan Pavetto, we've got a question. Is NAIF interested in funding water projects?
Oh, Louis.
Yeah, absolutely. We are interested in funding water projects. I guess the main inhibitor so far for us in terms of funding water projects is the fact that we have to provide debt. Our key product obviously is debt. Obviously that's changing with equity, but for a debt product, we have to, one of our mandatory criteria is to demonstrate an ability to repay. And what we've found with, this is not the case for all water projects, but most water projects, is the cost of the infrastructure up front is so significant that ultimately the cost of the water that we need to charge for it would be in order to be able to service the loan would be astronomically high. So I think the right combination for NAIF to participate in a water project would be a combination of debt from NAIF and also some grant funding. There is obviously now a significant amount of grant funding available in the market from the Water Authority grid. So that's kind of where we're focusing our attention on some of those larger water projects where the right mix capital stack is a combination of grant funding as well as debt funding from NAIF.
And so as you're seeing and through Townsville, you're seeing quite a lot of talk around the different dam projects, which are being run by the Northern Australian Water Authority and also the Water Grid Authority. Behind all of the technical work about how to build things and the work about looking for markets and that sort of stuff, there's another piece of work going on, which is a discussion about how you might put some structures together. We're certainly involved in those conversations. Those conversations have a little bit to go, but there was one line that one of the people in those conversations used, which I think is very relevant to where NAIF fits in, and certainly setting expectations appropriately. They said they knew NAIF wasn't the answer, but it was part of the answer. And it's finding that part of the project where NAIF can fit in, which is important for us as the challenge at the moment, but we think we'll work our way through it. So definitely interested in those water projects.
Good. Thank you for that. We've got a couple of questions from Gareth Jones. First of all, what is the current minimum level for a project? I'm presuming he means dollar limit prior to the 30th of June passing of legislation. And the second part of the question, how long does the process from application to funding on average take?
Yep. I'll answer both, but then Louis is actually responsible for breaking the record for the fastest deal that's been approved by NAIF. So we can talk a little bit about improvements of process at well, not so much our end, in part with our partners in the state. So I mentioned the states being involved in the process before. We have a great relationship. I said it's not their fault that it delays the process, but it's just another thing to add on, which has caused some delays. So the first is there's no actual minimum. We have done deals, I mentioned 15 to 20. We have done one or two transactions at smaller than 15 to 20. However, the key is just efficiency. And the efficiency comes around the fact that we're a smaller organisation. So, it takes as much time to do in so many ways a small transaction as a large transaction. But also being the Commonwealth Government, we bring a little bit of extra costs because of that in the setup. You also have to comply to our public benefit. And also, which is, I think, quite a productive thing, you have to complete an Indigenous engagement strategy. So there's a whole range of different things which add a little bit of cost, which sucks up the benefit of the concession, we think, up to around that $15 million mark at the moment. So when someone comes to us with something smaller than that, we have a chat to them, and more often than not, we'll advise them that just because of the efficiencies and what we've seen and how it models, that 15 to 20 is about the minimum that's effective, where you really see the benefits of a NAIF loan. Now, how long does it take? Well, in many ways, there's our process, but also how we interact with the other players. Our process, for those that aren't aware, is that we have a large group of prospects, as any organisation like ours would. When a prospect moves to a point where they are at the stage where they can convince the people running the relationship, and that will be sector heads like Louis, that the project is at a stage where it can progress to receiving NAIF money, they go to our board. Louis will take a paper to our board called a strategic assessment paper. Now, a strategic assessment paper is an explanation to our board about the opportunity and about why NAIF should invest time and effort working it up to a point where we can invest money in it. So the board will consider that. That's our first gatekeeper place. After it gets through that, we go through that due diligence phase. And that's where, the proponent has to show that the project has legs. And importantly, when we're dealing with debt, and similarly when we're dealing with equity, just from a different angle, how they can repay the debt. The last thing you want to do in this world is lend money to people that can't pay it back. That doesn't help projects, and it certainly doesn't help proponents, and it's morally not a great place to be. So can we come to a place where we have an understanding that the money can be paid back? One point that I always make in these conversations is that because in the debt part of our portfolio, which will remain the majority, we have to deal in debt, there's an accounting definition of debt. And the accounting definition of debt is you've got to get a better than 50% chance that you can get the money back. And in NAIF's case, that is reviewed by an independent credit officer. So it's not Louis and it's not the board who make that decision. An independent party looks at what Louis puts up and what the proponent puts up with Louis and works out whether or not that proponent has a better than 50% chance of paying back the money, and hence whether it's really debt or not. So anyway, Louis and his team go through that with proponents, and then it goes to the board, and then they have what I described before, an investment decision, which I'll simplify to say is basically the offer of money. So if you meet certain conditions after investment decision, then NAIF is prepared to offer you the funding that you require for your project. You go through, you meet those conditions, you get to contractual close, and then you get to financial close when the money starts to flow. Now, how long does that take? Well, the fastest that we've ever done was a few months ago with CQU, which I think was it 3 months beginning to end?
Well, about that.
3 months beginning to end. At that investment decision stage, let me just say, we go to the Queensland government and they go through a bit of a process which we run. The proponent doesn't get to see as much of that, but there's a process we go. So 3 months is what we did for CQU. We've had others which have gone 4 to 5 months. A lot of it is decided by the information that we get from the proponent. Our sort of systems are reasonably well developed at the moment. So it's about how quickly it takes from that SAP stage to investment decision stage to get the information from the other party. But if that comes together, I think where we currently stand at the moment, from initial conversation, strategic assessment, investment decision, contractual close to the money, I think we can do it in 4 to 5 months.
4 to 5 months.
The only thing I'll add to that is with the legislative changes and the ability to do corporate loans, it's a fact in banking that you can actually do corporate loans much faster than you would do project financing. So we expect that those time periods should start to get on average shorter as we start to do more of those types of loans, because I guess from a credit analysis and a number of parties involved, that they tend to be more efficient.
Indeed, that's a very good point.
That's good. Thank you for that. A question from Carl Valentine, a couple other comments and questions coming in. From Carl, will companies seeking equity funding need to submit an information memorandum or similar? And do you have any general commentary on the anticipated application process and documentation processes that would be required? Not sure how much detail is available yet, but also interested in discussion around valuation methodologies, dividend expectations, framing up shareholder agreements, etc. If you've got any comments to make on how that is shaping up.
Well, I've got some thoughts in that space, but Louis, you've been observing what the investment team has been thinking around that. Do you have anything to share in that space?
At this stage, I think the way, and again, this is an evolving process, but I think the way that equity investment process is likely to work is where we're also a debt provider. So we will obviously look to provide a level of debt. One of the conditions typically when you're providing debt for a project is they have to secure the equity amount. And if we find that during that equity raising process, there is a gap in the equity amount, we could potentially look to fill that gap. So I guess the submission in relation to the equity investment will, I guess, be supplementary to the debt because there's a slightly different lens and all those things that were mentioned around shareholders agreements and various other valuations. All those things will have to be hashed out during the project. But at this stage, I don't know that we would look to purely invest just equity in a project. I'm happy to be corrected. I know this is evolving, but it'll be typically a situation where we're a debt provider, an equity raising has gone out and there is still a gap. And if it makes sense for NAIF to fill that gap, that's the scenario which I think it will be the initial way we'd use it, and it'll evolve from there.
And Lou, I think with the concept of an information memorandum, so under what you've described, obviously you have to provide the information as you would normally, which would be basically, I mean, it's a process where you're borrowing money from the federal government. So, you need a fairly high level of information because the federal government, A, doesn't want to lose its money. It also doesn't want to be in a situation where it has to come looking for its money either, because that doesn't look good for a government. So there's a reasonable amount of information there, but the team work with the proponent to help model it and understand where the pros and cons of the case are and to make the case for our Chief Investment Officer, Chief Credit Officer, my apologies, and also our board to approve it. And I think you're right to say in a lot of cases, if not all, the case will be that we have all the information for debt, which will also mean that we'll have the information for equity.
Yeah, at the moment, we're required to receive an investment proposal, which is really another name for that information memorandum as it relates to the debt. So I guess a natural evolution of that would be to also include the equity if we're looking for an equity investment.
One thought from the question too, Glenn, is you took the question asked about shareholder agreements and those sorts of things. One thing that we'll consider, obviously, in equity investment is get a bit of a sense for how the government might exit over time. And that's a negotiation and a discussion with the proponent. It won't be tomorrow. We'd be there for a reasonable period of time, I suspect, to get the majority of these sort of projects to work. But when you talk about agreements between shareholders and alike, then an understanding about how we exit as equity holder would also be part of that.
Good. Now, I'm conscious we've only got about less than 10 minutes now. We still have got a couple of questions, but finishing off on Carl's point, he's come back with some comments here for you to consider into your mix there. I think you might be able to read them from your end as well, but just so sharing them with everyone, is that Carl suggested that limiting equity investments to only those entities to whom debt is also provided is a real limitation. Carl respectfully suggests that standalone equity investments should be considered. Companies that aren't able to raise debt finance can really only raise equity. So that's just a comment from one of our financial leaders.
Take that on board. Thank you, Carl, for that feedback.
To give you to think about that. If I could also go on to another question, we've got one here from Thomas Herridge. And I think you may have touched on this earlier when you said dollar values were being reduced. But Thomas's question is, loans of lower values were mentioned. Could we be seeing small family farms taking loans of as low as a few $100,000 as long as they meet NAIF's mandate, automation projects, etc. So I heard you mention $1 million figure below before. Is that your sort of minimum going forward, or do you have any further comments about that?
Maybe one for Louis. The minister has asked us to get as low as $1 million. So that's the benchmark he set for us.
Right.
How do you see the aggregation?
Look, I think the only inhibiting factor there might be sort of consumer credit code type issues. And we're obviously, given where we are in the legislation process, still going through and getting various bits and pieces of advice as to how it would work. But that's the only sort of issue that I can think of if you're looking at loans below that $1 million mark. But certainly we're certainly going to be looking at that.
We'll take that on board. I mean, I like what Thomas says there about things like automation, and we've had, if that's, they're the sort of things, if it's bringing growth to areas, and hopefully, I mean, the opportunity for employment growth in other areas, then that's the sort of stuff we'd like to be involved in. But there's a few issues, obviously, from what Louis is saying that we need to iron out.
Good. Thank you for that. We've got a question from Patricia. Patricia also said it was a correct assumption about the NT that projects there would often be the 3 to 5 million mark. And Patricia's also asked a question: do you look at funding research projects, or must it be commercial ready?
The big thing for us, and Louis might tap in on this one too, come in on this one, but the big thing for us is, even under the new model, we still need to be repaid. So NAIF's a different type of vehicle to a grant vehicle, which people have a lot of experience with, where, there might be a grant program for research and development, and there might be a grant program to start really new businesses without a great track record. And they all have a space, and they're all very important to the funding ecosystem of how we can develop Northern Australia. NAIF's space, though, is debt. And equity now, but primarily in both cases, what the Commonwealth is trying to do there is, rather than provide grant money where it's making a choice that always that it's not going to get that money back, in NAIF's case, it's leveraging its own balance sheet. So it's basically borrowing a bit of extra money on behalf of the Commonwealth of Australia, and then on lending it to people and proponents who are prepared to develop Northern Australia. So it's as I said, it's taking the balance sheet of the Commonwealth and leveraging it further. So in that case, we need to get a real certainty that we'll get the money back, because that's the principles of debt. It's also the principles of what the government's concept is. So unfortunately, research and development, because of the unknownness of the outcome, won't fit that bill. But there are other programs, I hope, which can continue to fund research and development across our mandate area.
So certainly in the ag space and remote help. I'd give a plug for the CRC for Northern Australia. They do some great
very good.
innovation,
I agree with
great
you.
projects in ag across research and private sector. So I'll give them a good plug. We have another question here from Gareth, and quite relevant in certainly in our region where there's some cotton trials going on at the moment. And he asked a question about, can there be aggregation to incorporate perhaps pieces of infrastructure, say a cotton gin, but also enable investment in contributing farming infrastructure to help support the farm-based development to ensure the success of the processing downstream. So it's almost like a vertical integration of the infrastructure to make all the parts sing and hum and be successful. Do you have any comments about how that might look?
Louis, you've done more thinking on this space than myself. I know you've looked at some cotton projects around the place.
No, absolutely. And hopefully I've understood the question correctly. But so the way we sort of look at those sorts of projects at the moment, and there probably is a few in our pipeline that we're looking at, absolutely we want to sort of, bring different players together. But in terms of if the question's in the context of aggregation around aggregated loans and our smaller loans, those types of projects certainly would qualify. I don't really know how else to answer that question. So we will absolutely look to fund individual parts of those types of projects under the loan aggregation scheme and bring them together. If it's large enough, we can go through our normal process. So short answer is absolutely we would look at those sorts of projects.
The one thing I'd add to that too is that with all of this, because I mentioned in equity, we're breaking new ground in many ways about how Commonwealth entities deal in this space, or at least deal with a concept like equity. In aggregation, the Clean Energy Finance Corporation has done some projects like this, but again, we are sort of again breaking some new ground on that. As we get more understanding about how aggregation might work, then we will have an opportunity, I think, over time to give it more of a policy focus at times. And if that is the case, that there is a large piece of infrastructure that's constructed that might start a new industry in a place, and you talk about cotton gins, you could talk about changes to the sugar industry, you could talk about changes to the way in which, I don't know, different sorts of fuels that might bring more efficiency and that sort of area. As that comes together, we need to develop the concept, and we're not there yet. But as Louis said, there's no reason we can't do it. In fact, in many ways, we'd encourage proponents to come forward with those sort of concepts to test the ideas for us. In the first iteration, in the next couple of months, we'll be doing what I call the all-comers concept. But if people want to test the idea with us about how we might narrow that down to specific regions and industries, very keen to have those conversations.
Thank you. And I think we've got the last question here. And Gareth's on a roll here. I like your question.
Good on you, Gareth. Thank you.
Once funding is approved and the financial offer is made, is there any further involvement or meddling by the Commonwealth in operations of the business?
Good question. Louis.
Is this in the context of debt or equity? So in the context of debt, obviously we sign a loan agreement with the business, with the company, with every proponent, and those loan agreements are bespoke for that project. And within that loan agreement, there's obviously certain obligations in there around reporting, representation and warranties, testing of covenants. That is typical of a banking relationship. So I don't know that we'd go over and above what is the typical banking relationship. Some of the things we obviously look at that are not typical is around Indigenous engagement. There's some ongoing obligations or reporting obligations in relation to that. So the Indigenous engagement strategy will involve certain goals that need to be sort of set throughout time. But other than that, there's no meddling, if you will. We don't want to tell people how to run their businesses. We obviously just want to protect the government's interest as a lender, as any normal lender would. So hopefully that answered the question. And just then to talk about equity very quickly. Yeah, equity is the other. In equity, we're a part owner. So we would in that case act as a part owner, as in we can't control it and we wouldn't want to. The Commonwealth doesn't want to, but I'd suspect we'd have board members and those sorts of things as part of that arrangement.
Excellent. Well, thank you so very much for that. I think we're just about right on time, and we've certainly had some good questions there, and want to thank Gerard and Louis for their time today. They're both dialing in from Brisbane, and we've been delighted to have people from near and far join us today. It's been a good crowd. So from RDA's perspective, thank you guys. It's been terrific to get that update from you, and in particular the insights to those various questions that are important across our region. So just in closing, thank you from us. Also for anyone dialing in to keep in touch with RDA through social media and newsletters, please let us know if you'd like updates from us on a regular basis. And also tomorrow morning, we're doing an 8 a.m. webinar. I believe Jared's jumping on a plane between now and then. He'll be dialing in from Canberra tomorrow, so thanks, Jared. And we'll be doing a focus on manufacturing and infrastructure, manufacturing and mining. And while everyone's welcome from every industry, there'll be a few references to those industries in the presentation as well. So we're looking forward to that tomorrow morning. As a reminder, by the end of business today, tomorrow, we plan to be able to load up the presentations and also the webinars so that you can refer friends and colleagues or take another look yourself if you missed any of the opening remarks. So thank you for your time today. It's been terrific. We hope that's been helpful to you. And once again, thanks Gerard and Louis from NAIF. It's been terrific to have this session with you.
Thanks so much, Liz, and thanks to everybody who's on the call. Really appreciate it.
Thank you all.
Thank you. Good night, everyone. Cheers.
Good night.